Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington, the Federal Reserve. We'll talk a little gold and silver. Obviously, we're diving deep into the economic events, local and national, and breaking them down to kind of give you a bird's-eye view of what we feel like is taking place, and directly how it impacts housing, mortgage interest rates, people, you know, whether you're buying or selling homes, whether you're trying to figure out if you should buy a home, if you can buy a home. We're going to give you all of the information to arm you to make educated decisions here. If you haven't already downloaded or subscribed to the podcast on iTunes, you can do so at iTunes. Search Real Estate 360 in the search bar. Also, if you don't have access to that, you can stream it on the website at realestate360live.com. That's realestate360live.com. On the right-hand side, there's an Ask a Question button for any questions you may have for us or topics that you'd like to maybe cover on future episodes. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert, Forbes, Wall Street Journal, Fox News, U.S. News, MSN, CNN, MSNBC, and numerous others. Louis, how you doing today?
I'm doing grand, Ryan. How are you?
I'm doing wonderful, Louis. So,
When?
you know, you and I talked just right before we just came on here, and it's, you know, highly predictable what's going to take place, and it seems like, you know, week to week we find ourselves talking about a lot of the same things. That's because not much has changed. You know, we often throw out that term insanity, right? Doing the same thing over and over and expecting a different result. So the only thing that they do different week to week is they just manipulate a different calendar event, meaning one week it's existing home sales, one week it's new home sales, one week it's non-farm payrolls, jobless claims. It doesn't matter. It's something different each week. They can kind of take the eye off the ball a little bit here, meaning the main thing that they should be focusing on is the economy. But since there isn't anything taking place there, they will tend to move things around a little bit and keep the markets guessing. Well, you and I are not really guessing anymore. We've been pretty consistent with saying that this is a joke, a circus, a sideshow, whatever you like to call it. But we'll break down the numbers again today. I want to get your insights. Obviously, you're predicting that the Fed will give a rate hike sometime late this year. I'm still kind of in a holding pattern where I don't really think anything's going to happen. I think it's more talk than anything else. Now on, let's see, it was a couple of days ago, we had non-farm payrolls come in at 280,000 versus an estimated 225. Unemployment rate was 5.5% versus the estimated 5.4. Average hourly earnings 0.3 versus 0.2. And then the day before that, initial weekly jobless claims came in at 276,000 versus 280,000. You know, it's interesting because it's always, you know, they'll have these numbers and they'll come out with revised numbers, and I would not be shocked if the numbers are much worse when they revise them, or one of them will be better. But at the end of the day, I think, you know, it's not necessary to even have to look at these numbers. We do because that's what everybody else pays attention to, and we want to be able to break things down on a level that's consistent with what the information that our people are taking in. But I just don't see any bright spots in all of this, and I want to kind of get your take on it because you and I have talked at length about using the eye test out there, listening to what people are saying. Outside of Wall Street hedge funds, startups, and everybody else, I mean, who's actually thriving in this type of market? I mean, you know, typically your entrepreneurial type person is going to be the one that thrives in a market like this because they're not dependent on others. They're going to go after whatever it is on their own. But, you know, that's not the majority of the United States. The majority of the United States is comprised of W-2 employees, government employees, those that are working for somebody else. Arguments are that there is not inflation, which we know not to be true, and basically everybody's thinking that minimum wage should be raised. That's not the answer either. There's not many bright spots, I think, is what I'm really getting at, Louis, and I'm wondering, curious, if you have anything.
Anything. Oh, I got plenty. Okay, Ryan, this whole thing has been a con game since the end of the financial crisis. And there never was an end of the financial crisis. Let's say since the beginning of the financial crisis. The Fed decided they were going to fix the financial crisis by doing QE and using also in coordination with Congress the stimulus. And if they had said 6 years ago, the way we're going to fix this is we're going to print $4.3 trillion and we're going to buy 90% of the newly issued U.S. Treasuries. We're going to buy $2 trillion worth of unperforming mortgage-backed securities off the too-big-to-fail banks. The dollar would have collapsed. There's no way they could have made the announcement that they're going to print $4.3 trillion over the next 6 years because they didn't see any way out of this. The economy wouldn't be better. They were going to keep interest rates at zero for this time. The dollar would have collapsed. And that's what they did. They printed $4.3 trillion, and they kept interest rates at zero for all that time. And the dollar didn't collapse. The dollar actually is higher now than it was in 2009. Now, why is that? Because they play this game, this back and forth and back and forth. We're going to raise rates. We're not going to raise rates. The economy's doing well. No, hold on. It's not doing that well. The economy's accelerating. No, the economy's not accelerating. So they've based this whole recovery on things that they know they can manipulate, which are the stock market. We call it the three-legged stool, propaganda stool, not school. They push the stock market higher by keeping interest rates low, by encouraging companies to buy back their own shares. And if that doesn't work, then the central banks themselves are also involved buying shares in the stock market. We've got evidence of that. Swiss National Bank lists the stocks that they own. It's 100% pushed by the Fed. And one of the things they said about zero interest rate policy and QE, Yellen said it, Bernanke said it, was to boost stock and real estate prices. Why? They say, well, it creates a wealth effect. People feel richer, and they go out and they spend money. That's not true. People just get richer. Rich people don't necessarily go out and buy more goods and services if there's only 1% of them. So it really doesn't boost the economy. It just boosts asset prices, which makes things expensive for the rest of us. Housing prices go higher. Insurance is higher. Fuel costs are higher. So it's not like the spending has helped anything. There is no increase in spending because people have borrowed money, they're tapped out, and they can't spend anymore. So you've got that three-legged stool, and the third leg, after real estate and housing prices going higher, are the job recovery. Because you cannot tell people there's a recovery just by pointing to the stock and real estate market, because they know not everyone's in the stock market. They know not everyone owns a home. In fact, during this whole recovery, the home ownership rate has gone down. Rents have gone up, but the home ownership rate has gone down. So they can't necessarily trick people into thinking the economy is doing well just by pointing to those two. So they point to, this is one with the biggest propaganda is, Ryan, is to the labor market. They like to say the labor market is robust, solid. And last week they came up with a new word, sturdy. You know, they have to keep coming up with words to tell people that part-time jobs are a good thing. And not just that, Ryan. They came out with the non-farm payroll after a spate of a very good non-farm payroll on the surface, after a spate of very negative economic news. Now, the first quarter was bad, right? Mm-hmm. And they tried to tell everybody it was the weather, and they got everybody all excited, and they said, okay, don't worry about the first quarter. So the media reaction to the first quarter GDP numbers being revised from a slight positive to a negative was met with a bunch of stories like the weakness in the U.S. recovery is not like a cart losing its wheels because the labor market, remains healthy and housing activity is picking up. That was in Yahoo Finance. AP says the economy shrank in the first quarter but is staging a recovery. Then they say, but activity has already rebounded modestly. That's not true. The second quarter has shown no improvement. In fact, some of the metrics have gotten worse in the second quarter, Ryan, than they were in the first quarter. But that doesn't stop the media from insisting that, no, the first quarter was weather and now things are getting better. Mm-hmm. And once they start to say things are getting better, Ryan, then what they do is they start to say, well, now we can raise rates. Well, the numbers haven't been that good, except now they've got the non-farm payroll number. The non-farm payroll number now is evidence that things are doing better. And the problem with the non-farm payroll number, Ryan, we mention every week, is not only the jobs created, part-time jobs, but they're also going to older workers, and that the labor force participation rate amongst older workers is improving, people that should be retired, and is decreasing amongst people ages 25 to 54. That's not a job recovery. But what makes it worse is the jobs that are being created, or they say are being created, there's no proof of those jobs being created. It's all based on the Bureau of Labor Statistics coming up with a model that says we assume so many businesses were created during the month, and therefore those businesses created this amount of jobs without any evidence that that's the case. But when that number comes out, that's the monthly number, that seems to be the most important number that shows you where the economy is headed. And of course, when you have a good non-farm payroll number, now it's off to the races, and everyone can say, or wants to say, that the economy is doing better. Then you get on the heels of that, before that and after that, the talking heads in the media and also in the Fed talking about whether they're going to raise rates. And here's the most important part. Right? On last week, before the non-farm payroll came out, you had Fed President Evans of Chicago saying he doesn't see rate hikes being any rate hike until early 2016. The IMF comes out, which is run by the United States, says don't raise rates. Economy is not ready, global economy. Then you get the sturdy jobs report that comes out, and of course, all the media saying this puts rate hikes back on the table for September. And then Fed President Dudley comes out, and he says, yep, rates are still on track for this year. And then you had the St. Louis Fed saying, oh, don't worry about the first quarter numbers. There's a seasonal adjustment. You should just ignore the first quarter. Then the New York Fed comes out yesterday or 2 days ago and says, no, that's not true. First quarter is fine, and the way we calculated it is fine. So you see what's going on, Ryan. You have internal propaganda where they're arguing with themselves about what they're going to do when they know what they're going to do. They knew in 2009 that QE was going to last forever, and they couldn't do anything about it. But they can't come out and say that, so they have to argue they're going to taper, they're not going to taper, they're going to raise it. They have to go through that whole charade. But my view is this, Ryan, that they will raise rates. They have telegraphed that they're going to raise rates. And all this no rate hike talk is just the sucker's play to keep the sheep in the market. Because if they make it sound like it's definite and there's no two ways about it, and in September they're going to raise rates, then the market would sell off. They're giving the insiders time to readjust their positions, to sell off, do what they have to do, while pretending that maybe they won't do it. We saw with the taper. They went back and forth, pretended they would, maybe they won't. But they ended up tapering QE, and they ended up supposedly ending it. That doesn't mean they won't find other ways to funnel money around. But on the surface, they did end QE, and they will raise the interest rate a small amount. Ryan, the 10-year note has already gone up more than a quarter point that they're going to raise the Fed funds rate. So it's already baked in. So it really doesn't matter. And as we mentioned at the start of the call before we got on, after they raise the interest rates a quarter point, whenever they do that, this year, next year, then they start talking, well, maybe we might raise them in the future, maybe we won't raise them in the future, it's data dependent, look at this non-farm payroll number, it's robust, oh, look at this is down, we're not sure. All they want is to be given the power where everyone's paying attention to them and not sure what they're going to do. Because if all they came out and said was, we're going to just print money for 10 years, no one would listen to them, no one would pay attention to them, and the dollar would collapse. But because all this attention is given to them, they have the power to control where the economy goes, where the money goes. They cannot just come out and say, okay, we're done with QE for now. It's Bank of Japan's turn. It's European Central Bank's turn, the general central bank coordinated manipulation that they do. They have to make it sound like they're independent, and then they're doing this, and they're really paying attention to the economy. They're not. They're going to raise rates. They're going to pretend like they are. They're going to pretend like they're not. But I think they're going to, Ryan.
Well, you're right. They can print money for an extended period of time, 4 to 5 years before they actually have to make a move, right? So if they make a credibility play and raise rates, they can continue to do what they're doing for another 4 to 5 years and then make another move. They don't do anything very quickly because they're stuck. They know they're stuck. They can't really do anything that's going to change this. You know what I find interesting is that many of the so-called billionaire hedge fund guys, like Paul Tudor Jones, to name one of them, talked about the wiping out of the middle class, which we've talked about on the show for some time now, right?
Mm-hmm.
Low interest rate environment, it's basically decimating the middle class. And many of these guys are coming out saying, that this is not sustainable, this is going to end very badly. Now, a lot of them are trying to position out in front because when it happens, if they're the ones that say it and it happens like a couple months later, they're going to look like a genius. Mm-hmm. So, but I firmly do believe, though, that there is some rationale behind it, that they're scared because, some of the thoughts are that these things are going to end one of three ways. And Paul Tudor Jones says rising taxes, war, or revolution, because something's got to happen. And it's not going to be the Fed making the move. It's not going to be this. It's got to be something else, external. That's going to, and it's going to probably be, people are dealing with inflation that they're saying is not there. They can't make ends meet, even with their WIC cards that they're getting. And 44% of Americans that are on some sort of entitlement program, it's not going to be enough. Are they going to raise that up to help the rising costs of healthcare and food and energy and everything else? Because I don't know if you've noticed, Lewis, but it looks like gas prices are on their way back up again.
Yep.
That was short-lived. So I hope.
And by the way, during that time period, consumer spending did not rise, and I wrote an article on this, Bankruptcy in America. It's because consumer debt has gone up 30% in the last 5-6 years. So consumers are tapped out on higher student loan costs, higher rental costs. They've borrowed money to buy cars. So they can't. There's no way you can increase the spending. It's got nothing to do with it being too cold out. It's because they're tapped out because they've already taken on too much debt, and now gas prices are rising. So the recovery over the summer and the rise in the GDP that they anticipate from increased consumer spending isn't going to happen.
Well, then you have Bloomberg coming out with an article. Everybody was touting the millennials, right, and why they need to start purchasing and why they haven't been. They've been hesitant, whatever it may be. They come out with an article that says, essentially that there's 13 cities that the millennials have been completely priced out of the housing market. And they go through and they're showing all the metropolitan areas, and they're showing the name of the graph is 13 metropolitan areas with home affordability gaps. And as you can imagine, pretty much a lot of the major cities, San Jose, San Francisco, Los Angeles, San Diego, Riverside, Sacramento, so majority of them are all in California, which is not a surprise. Denver, Portland, Seattle, New York, Boston, D.C., and Miami, Fort Lauderdale. Now, interesting when looking at this graph is let's just take the top one, San Jose, California. They're basically saying that the average millennial would need to make an extra $80,000 there in order for them to have a chance to qualify for a home. Okay? San Francisco, an extra $60,000. Now, the median millennial earnings for those two places is $53,000 and $49,000. I doubt that that's even enough, even if they were to get their earnings up that much, that they're still going to be able to afford that. You know what I mean?
Correct.
And they skew these numbers. I'm looking at all the median millennial earnings all the way down the board, and I don't see anything over $53,000 in San Jose, California. Okay? The reality is, guys, that this is actually taking place everywhere. It's not just the metropolitan areas, but what they're trying to highlight is that they're being priced out in the metropolitan areas. Well, that would kind of make sense because guess what? In those areas, it is going to be more transit. There's more jobs. Valuations are probably going to rise there more than the rest of the country. I don't see too many rural places in here, North Dakota, South Dakota, Alabama, Illinois, Michigan. We don't see too many of those on there, do we, Lewis?
Nope.
Because those actually would be somewhat affordable. $5,000 for a home in Detroit, if that. I mean, that's not the issue here. And we can talk about these new waves of buyers all we want. The Fed can't fix the problem. They can't. Everybody thought they could. They create a low interest rate environment and everybody's going to snatch up houses. No, That's not to say I'm a real estate agent, guys. I understand. Agents that listen to this podcast are going to say, well, my area is red hot right now. I'm not saying that you can't have an area that's red hot. You can have an area where the inventory is still low, certain price ranges, and properties are moving 2 days it's going on the market. I get it. It happens.
Job market is strong, sure.
Yeah, it happens. But a lot of them are anomalies. It's not like the whole country is going through this right now. We should have probably double the amount of existing home sales if it was as good as everybody's making it seem.
Across the country, yes.
Across the country, with the interest rate environment that we have, and for the supposed jobs that are there,
exactly.
For the affordability levels with the interest rates where we're at, for the mortgage guidelines that have somewhat loosened. I mean, as I mentioned, I talked to a few lenders the other day. You can get an FHA government loan, a VA government loan. You're allowed to push your debt-to-income ratios up to 57% of your total gross income. That's with your mortgage payment, all your other debts.
But some people don't want to. But some people don't want to do that, Ryan, because they don't see the value. They think the home prices are too expensive, or they're worried about losing their jobs, or they have two part-time jobs and maybe they lose one of them.
I wouldn't want to do it either, Louis, because I can tell you why. Because they haven't factored in anything. They haven't factored in the grocery bill, the energy bill, the health care bill. They haven't factored in any of the other insurance.
Right. So the person understands that if they have to factor in their higher insurance costs, that they won't be able to make those payments anyway, even though they're allowed to go that far on the ratio.
The one argument that I do believe of why millennials can sit on the sidelines is that I do believe that they watch their parents go through and lose their home and overextend
Absolutely.
themselves, right? So,
I mean, what's the point? You don't own your house if you're going to end up losing it.
Right.
Why buy something, put all your time, effort, and money into it, and then have to give it back to the bank? If you rent and you lose your lease, you leave.
Yeah, and so what's mind-boggling is that, when somebody can afford, like on paper, they could get approved for like a $400,000 house, but yet their comfortable payment is $250,000. Now, Louis, you can imagine if there's a $150,000 spread there, there's not going to be much out there, right? There's not going to be much out there as far as inventory that's going to make that person happy, that they could see themselves buying the house. So,
well, in a lot of those areas, Ryan, didn't investors buy up by cash a lot of the cheaper houses and then rent them out, which effectively shut out the people from buying those houses, the cheaper houses?
Of course. I mean, you get the investors that are looking for cash flow real estate,
right,
buying real estate as an investment, and they're snatching up those homes, renting them out for positive cash flow. So, yeah, and that has happened a lot, especially in the metropolitan areas, because they tend to rent much easier, much faster, and for higher rents than the rest of the country. But at the end of the day, making excuses, Bloomberg, is essentially what you're doing. Because before, if I remember, you were touting the millennial market, and now we're talking about there's a home affordability gap all over the place. Well, this is not really new news, right? We know that there's a gap because we have how many seniors taking jobs from the millennials right off the jump.
Yeah, did you see the Wall Street Journal, Hilton Rath, the guy who's supposed to have the inside track to the Fed? He wrote an article, "Dear consumer, how come you're not spending? The sun is shining," and so on. And the comments were priceless. They're basically saying, "Oh, you're an idiot because you don't understand that the consumer doesn't have any money to spend. Mm-hmm. The consumer is tapped out, and we don't spend according to your models." I mean, they're furious, the central planners, that people are not spending money and that they're even thinking of saving money, which isn't really true. They have spent money. They spent more money in the last 3 years that they shouldn't have spent on credit, buying cars, student loans, on HELOCs, on all types of consumer credit. They just can't afford to spend it anymore because they haven't gotten raises and they haven't gotten the jobs. It's got nothing to do with the weather. And now they're saying, why don't they buy houses? Remember that article we criticized? Why the housing market will go ballistic in the spring? No, it won't, and it didn't. People don't have money to buy houses. They have to pay all their debts off. And it goes in a cycle. They're tapped out right now. And unless somehow the job market improves and not the Bureau of Lying Statistics job number, but actual real jobs are created, that full-time jobs that pay decent money, when we lost a lot of jobs in the shale oil bust. So why do we think that people can spend money? Because you tell us to spend money that we don't have? It's unbelievable, the arrogance. They think that, look, our models show we did all this fiddling around in central planning. How come it's not working? Well, there must be something wrong with the people. There's something wrong with the consumer. They're hoarding money. They're not hoard. You can't hoard what you don't have.
Well, and everybody keeps wondering, I'm talking about the middle class being decimated, but think about it, guys. If they're making the same income they were making 6 years ago, which many are making less, right?
Right.
Many positions have been cut or job responsibilities taken away or reduced to a part-time employee versus a full-time employee. But if you're making the same as you were 5 or 6 years ago, they can lie to you all they want and say that there's not been inflation, but we all know.
Of course there is. No, they even say there's been inflation. They say it's 2%, but 2% over 5 years is a big number.
Of course it is. And when you don't have any wage growth,
correct,
over those 5 years, you're going in the hole. That's the way basic math works.
Yep.
And at the end of the day, that is what prevents people from being able to buy houses. Now, if you were saying that, okay, there's the 2% inflation and wage growth is at 2.5%, okay, well, maybe you can keep up.
You're outpacing, all right. Well, what about the ridiculous argument they said, well, rents are higher, that's going to cause people to buy. No, if rents are higher, they can't afford any housing.
And now they have to partner up with somebody else and go in with
exactly.
A friend, a family member, a relative, get them to co-sign. I mean, yeah, it's not as simple as just you wanting to go and get a place. As a matter of fact, the investors that I've worked with lately are getting more stringent on who they're renting to. So they're not going to just let anybody in their house. They don't want to have issues down the road of somebody not paying. So they're tightening up on applications. So now, if you can qualify, like I said, there's still 100% programs out there. But at the end of the day, does your income support those?
Right.
It may on paper. And I think that this is the biggest point that many people don't want to recognize, is that just because you qualify for something doesn't mean that you can afford it. And I think that the way the media pushes stuff out there is that mortgages are available, millennials you should be able to buy, except in these metropolitan cities now. Just go and get your loan, get a house. But actually that's setting them up to fail, because the reality is they're worried that their wages aren't going to go up, that their expenses are rising every day, that every time they walk in the grocery store, their bill is $100. How can they get away from this? How can they make their meet that big obligation of that mortgage? That's what it is, and it's this
right when they have a car payment and they have a student loan payment. They don't seem to stop buying cars though. Car sales are up. The average FICO score is 552 on an auto loan, and 13% of car purchases don't even have a FICO score. They don't care. You're back to the subprime housing thing here, only in autos. I guess people are living in their cars.
And it was only a matter of time, because as we talked about before, Louis, we said that, the mortgage market, right, there was no real alternative markets other than just, your conventional and government loans. But now we actually do have some stated income loans that have made their way back into the market. Now, with that said, they're much higher interest rates, and they're really only for self-employed borrowers, but they did come back. Everybody said they would never come back. People forget, and especially the people on Wall Street, especially the traders, especially the hedge funds, especially the rich, right? Because when you know that you have somebody backstopping you, the most powerful people on earth, essentially, with the Federal Reserve, it doesn't matter what you do.
Right.
It doesn't matter what you do. It doesn't matter who you give loans to, because there will always be somebody to bail you out. Now, that doesn't mean every company, but the big guys, they know who they are. They can take these risks all day. They can pay these fines all day long. They'll make double the amount of money, triple the amount of money that they're paying in fines.
Oh, more than double or triple.
But it's just a way to make it seem like, oh, you're going to get smacked on your hands. Don't do that again, Johnny. Right? And then
if they can make money doing it, they'll do it.
While the average American, the middle class, continues to struggle. But
being told that we're not struggling, that everything is fine. In fact, it's getting better. It's robust, sturdy, solid, and so on.
Yeah, you create whatever S words you want, right? And it makes it all better. And it's unfortunate because, Louis, like we said, every week we're saying much of the same, just with slight variations depending upon what the data is that week. But it's like, okay, guys, how about somebody just acknowledge that things are not moving in the right direction? What is the long-term plan? Nobody will talk about it because they know inevitably this is the long-term plan. just staying stuck in the mud. The train has been has been headed to fall over the cliff for some time. They know that they can't pull the plug on a program. They're not going to tell anybody that, though. They're going to continue to say, "Oh, it looks like we're moving towards raising rates, and we've got the employment numbers where we want them. It looks like the real estate market's heating up. Watch out."
Yep. It's going to carry the baton and drive the economy. See, raising rates is code for the economy is better. The economy is robust. We have to slow the growth down. That's not what's happening. The reason they need to raise rates is just to keep demand up for U.S. Treasuries because we have insatiable borrowing requirements in the United States. We have to continue to borrow. We can't just print all the money ourselves from the Federal Reserve. We need to make sure that foreigners continue to buy our bonds. And, of course, if they're priced better and they have higher yields, then they'll buy them. If they're lower priced, then they won't buy them. If they're higher priced and have lower yields, they won't buy them. Mm-hmm. As simple as that. That's the only reason they're going to raise rates. They've kind of already talked their rates higher as it is, and then they'll just do the formality of doing a Fed fund rate hike. It's no big deal. I mean, all the people saying it's not going to happen, it's going to cause a disaster. It's not. It's already happened. The rates have already risen. All they have to do is pull the trigger. Then all of a sudden they look like the prudent central bank. They're the ones who did what they said. They say what they mean, and they mean what they say, and they raise the rates. And look how prudent they are, forgetting that they just went through a $4.3 trillion money printing spree. Mm-hmm. But that's what they're trying to accomplish. And I say they will because they pulled it off. The dollar came out stronger after 6 years of QE than it did going in, and now. The only thing they're concerned about is the dollar going too high, but they know that if they need to start printing money again or lower rates, they've got to be raised. So they got to push them up higher so they can bring them down again. And push them up higher doesn't mean push them to 4 or 5 or vocal range 13, 15%. It means push them up to a quarter point, half a point, the most.
Right, because realistically, that's not going to impact things much more than where we're at right now. Right. And it's gonna allow them to say, "See, we're in control of this. We've got we've got this train on the tracks, not coming off until the
QE was temporary, and then if something drastic happens, which they know is going to happen, then they can go back to QE again."
Yeah, where you have one of those things, where war, revolutions, or you know what I mean.
It doesn't even have to be that dramatic. Just something, a Greece default or a stock market collapse. Now they have to say, "Oh, well, everything was going well." And all you have to do in history is go back and look at all the AP and Reuters stories telling you how good things were. And you can say, "See, it worked. It worked, except then this thing happened." So that's the only reason they went back and did QE. Mm-hmm. Because who could have expected this? Look how great things are going. If tomorrow the economy collapsed because of some external event, the history books would, if you just go back and read Reuters and AP, the history books would say the U.S. economy had recovered from the Great Recession. The economy was robust, sturdy, and solid. Job was accelerating, and then this thing happened.
Yeah, millennials were on their way to owning their first home.
Correct. Home prices are up. The stock market was at all-time highs. It was one of the greatest times in America. We had job growth, longer job growth than any other time in history. We had low unemployment claims. It was one of the biggest rebounds in history. And then this happened. No one could have, whatever it is.
And that's why I can see the elections next year being, do you think that they're going to go back at the play, create jobs again with infrastructure, that whole deal?
Well, it depends on how they want to. See, Bernie Sanders is saying that the unemployment rate really isn't 5%. And the Republicans would be smart to say the same thing, that the numbers are not what they are and that they're a fantasy. But if people believe the numbers, like if Hillary believes the numbers, she can't argue we need to do infrastructure to create jobs because we've got great low unemployment. She'll have to just say we need to do infrastructure because we need to do infrastructure and she wants to spend money. Mm-hmm. Either way, they were going to come up with a way to spend more money. There's no two ways about it. Have bigger government, whether it's Republican or Democrat or Socialist Sanders, they will figure out how to get the government more involved in fixing, improving the economy, or just helping us all out by spending more money.
It's a two-part formula. The Fed's got to continue to print money, and the government's got to continue to spend it, right?
Right. Fiscal and monetary policy have to both be reckless. They both have to be, spending and printing as much as they can.
And it has been for some time. I mean, there's no accountability.
Well, the Fed claims that Congress hasn't done its job. Congress has been too concerned about the rate, the debt ceiling. Congress hasn't instituted more spending. That's the monetary people over at the Fed want to put the burden over on Congress and make them spend more. And of course, if they spend more, how do they spend more if there aren't higher taxes? They have to issue bonds. Well, who's going to buy them? See, that's what the Fed realizes. They can't increase their balance sheet more than $4.3 trillion. They need other people to buy them. And that's why they need slightly higher rates. And then people say, oh, but the United States could never afford the interest payments. Sure they can. The United States can't afford any of the payments it makes. It's in deficit. So what are higher rates that they have to pay, higher interest rates? They say that's going to bankrupt the country. No more than Social Security, no more than the military budget, no more than welfare, no more than anything else that they spend money on. Higher interest rates, so they pay higher interest rates. Right. And the way you pay higher interest rates, you issue more bonds. And the principal you get from the more bonds, you pay off the interest. That's how a Ponzi scheme works. All these people criticizing the Fed as running a Ponzi scheme are the same ones who say, well, you can't raise rates because the U.S. couldn't afford the interest rates. Sure you can. You issue more bonds. If you think it's a Ponzi scheme, well then realize they'll just continue the Ponzi scheme. And higher rates means you could sell more bonds, which means you could pay higher interest.
Mm-hmm.
I don't see why people think that somehow raising interest rates is a big impediment because now the U.S. can't pay its debts. It already can't pay its debts. And how does it pay its debts? By issuing debt. So if it has higher interest rates to pay, then it issues more debt. And how does it get people to buy more debt? It just raises interest rates.
Well, and
pretty
you
simple.
always, and you have the lender of last resort in the Federal Reserve. So
right.
If all else fails, if people don't continue to buy them, with rising interest rates, there's obviously going to be more foreign demand, right? Because there's higher interest rates to be paid on those bonds. So as long as we continue to tick those rates up, people will buy them. And if for some reason they didn't, the Fed could step in and continue.
Exactly.
Yeah,
it's not like they're going to stop spending because the interest rates go up.
Right.
The only thing I find amusing, though, Ryan, is they use that argument. They say, well, then the United States can't pay its interest. Okay. Then they say, there's no money left in Social Security. Why? There's no money left anywhere. Why don't they say there's no money left for welfare? There's no money left for anything. But they pick on Social Security because they know that's one area where they can take it from you. Because there's no money left anywhere. By definition, if you have a deficit or unfunded liabilities, you can't afford it. Why don't they say there's no money left for the Department of Education? Why don't they say there's no money left for the EPA? They never say that.
No, you start to scare people to the point of...
Well, no, because those are areas where they have people that are dependent on jobs. They create these agencies. The government will never scale back itself, but it'll say, well, it can't afford to pay you. And they know that people on Social Security are older, and they're not going to riot. So they always say, well, there's not enough money left in Social Security, which is the biggest insult because that's actually money that was paid in on the pretense that they were putting it aside for you, specially, that it wasn't a general tax fund.
Yeah, it is wild, and they, they know there's no money that's for there, like you said, for anything. But at the end of the day, like, we're in such a strong economic environment, right? It literally is comical. It doesn't.
We're going to grow our way out of it.
It's never going to happen. And like you said, well, it doesn't matter about the trillions and trillions and trillions, whatever the true number is. It doesn't matter what that is because it's just a number. And as you mentioned, that number can continue to grow because why? They can just issue more bonds, and they can.
What's a quarter-point interest rate? They can't afford that. That's going to throw everything off. That's going to throw the books out of balance.
Well, no, I think they are cognizant of the fact that they can't let rates go too high too quick because then that would affect the Americans as far as credit cards, auto loans, and those things. So they don't want
We're talking a quarter point here, Ryan.
No. I know. What I think people are thinking when they start saying the Fed's going to raise rates, is all of a sudden they're going to jump up 2-3%. You know what I mean? And it doesn't happen that way. If you look back historically, when they've raised or lower rates, it's in quarter point increments.
Yeah, but that was also, but they're not even going to do that. They'll raise a quarter point, and they'll talk for 3 years about when they might, or they'll do the same thing they're doing now.
Well,
it's not like they're going to come every meeting. They're going to raise it a quarter point.
Well, no, but we can write this down. June 9th, 2015. We'll see where we're at June 9th, 2018, right? And it'll probably be similar to where we were June 9th, 2012.
Right, just a lot of words and maybe a quarter point or two.
I mean, as we mentioned, we're going into the lost decades. You know.
Yep.
Inevitably, like everybody seems to think that we're invincible, that U.S. can't be touched, and the Fed, to their credit, they've devised a masterful plan, I guess, at this point, because they can continue to talk like things are better and that they've done their job, and at the end of the day, you and I, Lewis, can say what in the hell is going on, right?
Yeah, if you look at, it's hard to see it, but it's incremental. Where China was 15 years ago, it was nothing. Look at it now. It's a financial and military powerhouse.
Mm-hmm.
And it didn't hardly even exist. I mean, Japan was the big threat in the 90s, if you remember. Late 80s. And look what happened to them. They're nothing now. And that can happen to any country. Especially, and the reason it can happen to the United States is the United States has given up on what made it a financial powerhouse. It's more interested not in growing the pie, but in dividing the pie. It's more interested in political correctness. It's more interested in Bruce Jenner. I mean, those are the things that, gossip is gossip and sideshows are sideshows. They had them in the 50s. They had them in the 60s. But these are the major stories now that are covered. Things that do not really impact people's day-to-day lives. They force these stories into the national consciousness, but they're not what people need to do in order to improve their life. And when you get Hillary Clinton up there and she may be president saying, don't let anybody tell you companies create jobs, well, now you've lost it. Of course they create jobs. Even the Bureau of Labor Statistics says that that's how they come up with their jobs. They say companies were created and they created jobs. I mean, it's just an economic fact. But the United States really cannot continue in the current fashion without losing more ground unless it changes the mentality of what the United States is about. What did Calvin Coolidge say? The business of America is business. Someone says that today, that doesn't fly. You get Bernie Sanders out there jumping up and down talking about 90% tax rate and claiming that in the 50s we had 90% tax rate. And therefore, there was some correlation between having rates that high and prosperity. No, in the 50s, no one paid 90% tax rate. There may have been a marginal rate at that rate, but there were so many exemptions that people didn't pay it. Also, you had massive industrial production happening in the United States, which you don't have now. So all you'd be doing what are you going to tax? 90% of bankers' fees? There's nothing to tax because there's no wealth being created. There's only dollars being created. That's the big difference. In the United States, there was in the 50s and 60s, there was wealth being created. Not wealth, but there was production. There was actual value being created in the goods and services that were flying off the shelves in the United States. Now, most of the wealth created is in the financial sector.
I'd say the majority of it is all there.
I think it's close to 50% probably. That's why the bank's too big to fail. That's a real issue because that's most of the GDP. And then also the amount of money the United States makes just finding other companies in other countries. They find HSBC, they find Swiss banks, they find French banks, they find U.S. domestic banks. tens and hundreds of billions of dollars. It's like that's like instead of taxes. It's like the tribute that the banks have to pay to get the government protection.
It's trivial as to why would anyone would think that we're this productive society, right? That we used to be.
Well, they show the production had gone. The numbers also in the that came out last week showed that production is down, and the cost of labor is higher. That's the worst thing you can possibly happen. If employers have to pay more costs, it's not because they're paying higher wages, because they have insurance costs, and then their workers are less productive, you're going in the wrong direction. And then you're telling people everything is fine. And not just fine, things are getting better. You have an unproductive workforce that's underpaid historically, and prices are rising. And they're saying, we're going to raise rates. See, that's why the rate hike thing doesn't make any sense, because by the Fed's outward propaganda that they're concerned about the economy and they need to see things getting better. Well, they're not getting better, but you see the difference is they're just claiming they're getting better, so they're matching, they're creating a narrative to match what they want to do, which is raise rates, which doesn't exist. I mean, the economy is not getting better. All the numbers show that the economy is getting worse, and that the first quarter was not an anomaly. The first quarter had nothing to do with whether it was a bad quarter, and the second quarter is just as bad. But they'll fiddle with the numbers to make sure that the numbers look better in the second quarter to justify their rate hike.
Yeah, and we'll get to talk about the second quarter and why there was something, that the sun didn't come up enough days that quarter.
Pollen in the air or whatever.
Right. I mean, it's a joke that, business is business, right, Lewis? And just because, regardless of whether you still have a business to operate, last time I checked,
yep.
Business doesn't stop. But for some reason, with the media, the Fed, and everybody else, it can stop. It is allowed to stop. They're allowed to blame that. And this is what I always come back to. It's frustrating, but small businesses in the United States, they don't get an opportunity to take days off. They don't get an opportunity to say that this quarter doesn't count. They just flat out go out of business. That's what happens.
And they do, and then the Bureau of Labor Statistics says they didn't go out of business. More businesses were created, and they created jobs. So they just invent that assumption.
Oh, you know what? I can tell you what businesses were created, and this is the startup mindset and the culture that we've created. It's essentially the rich. It's the rich and friends of the rich, because what they can do is they can create companies out of thin air, Lewis. They don't ever have to be productive for 11 or 12 years. They create an idea. They get somebody to buy into it. A rich person buys into it, tells all his friends. They push a stock price higher. They don't ever have to be productive with that company. They don't.
You're talking about Silicon Valley. Silicon Valley is underrepresented in talking about the fraud that's committed, because they're the ones who tout these companies that make no money. They have pre-IPO valuations in the billions of dollars. Then they go public. They go even higher. And then in the aftermarket, they go higher. And 10 years later, the company still hasn't made any money. But many of the rich have made fortunes off of touting these companies.
Yeah, absolutely. And, the interesting thing is that everybody knows that most of startups fail. So if venture capitalists are pouring their money in there, they're basically taking a 1 in 10 flyer every time, right? It's not more than that. So it's not. They know that a lot of these companies aren't productive, but they'll throw their money in there because.
But even the ones that become so-called productive aren't even productive because they still don't make money. The only thing productive about them is they've managed to convince enough people to throw enough money at them to give them a high valuation.
Well, correct, and they're also going to convince the people that their strategy for actually making money has yet to come, right? It's 10 years from now.
Or they've convinced people that strategy doesn't matter anymore. People don't care anymore. Because, come on, if you have companies out there like Amazon, Zillow, and all these companies that have never made any money, what makes you think they will?
They won't.
That's not why people buy them anymore. No one's buying Zillow because they think it's going to make money. They buy it because they think it's going to go up.
Yep, it's up and up, and like you said, when they get to the point where somebody starts questioning what the company's all about, they pivot, right? They pivot, and they turn the company.
Or they merge with another company.
Yeah, or they merge and they go a different direction, and then it's just like everybody forgot about what that company had been doing the previous 10, 15 years.
Now they've got a new story to tell. well, the merger hasn't fully been integrated yet, but our projections are that the merger will bring synergies, blah, blah, blah.
Mm-hmm. Yep. It's interesting times, my friend, interesting times. But we're coming up on the end of the show here. I just want to thank you again for coming on. We'll obviously touch base back next week. Let our listeners know where they can check out your blog post this week.
Smallgold.com, SMAULGLD, smallgold.com. This week there's a blog post up there on bankruptcy in America where we list the top places where Americans have gone into debt to buy stuff. So please check that out at smallgold.com.
Thanks, Louis. Appreciate it.
Thanks, Ryan.
Thank you guys for tuning in. We'll be back again next week. In the meantime, if you have any questions, reach out to us on the website at realestate360live.com. Ask a question button on the right-hand side. And also subscribe on iTunes. Download, share with all your friends. Search Real Estate 360 in the search bar. Until next week, guys. Take care.